Hi, welcome to the Quality Momentum Trading channel. I'm Alvin and CEO of Dr. Wealth, and what I'm going to share with you in this video is the overview of what this Quality Momentum Trading strategy is all about. And the future videos I'm going to be doing will be based on this strategy to identify trading opportunities in the market. So be sure to understand what this strategy is in this video itself. I have broken up the video into three parts. The first is to tackle what to buy, second is when to buy, and the third is when to sell. As traders, we need to answer these three questions. So let's start with the what to buy first. Factors is what I'm going to use for these strategies. Okay, so these factors, what are we talking about? Factors are based on academic research. Okay, it actually came from the finance academia, where they use data to prove or disprove certain factors or certain styles, whether they work or they not. So there are a lot of factors out there, hundreds of them, if not thousands. Okay, but there are the 5 critical ones, the most significant ones that everyone should know. So these are the 5. Value factor is one of the earliest factors being found. And it is not difficult. If you know value investing, it's always about buying cheap and selling dear, right? So buy low, sell high. Okay, that is the mantra of value investing. And there's also a factor called size. And this may be counterintuitive to what you guys know. So size refers to big or small companies by market cap. And the smaller they are, delivers higher returns. Okay, so this is something that is counterintuitive because a lot of people think that bigger companies deliver higher returns, but based on data, the smaller companies actually deliver higher returns. And profitability factor, this is synonymous to quality factor. Okay, so basically these are the higher quality business that can generate more profitability, and this is something that is intuitive. Higher profitability stocks deliver higher returns. And the fourth one is momentum, right? And momentum, the higher it is, the more returns is going to deliver. This is more of the short term, which we will address in more detail later. And last one is low beta, and this is referring to the volatility. And the research shows that lower volatility actually delivers higher returns, right? So these are the factors that are out there, they're proven to deliver higher returns. The only thing is that they don't outperform all the time. At any one point in time, one factor may be performing the best, while the rest may be close or even far behind, right? So the factors always rotate. There isn't something that we can predict. But if we combine a few factors together, it will make the strategy more robust. So for the QMT, or the Quality Momentum Trading Strategy, what we are going to do is to combine the profitability and the momentum factor together, which I will show you how. But let me explain. How are these factors being generated? How do they discover and say that, okay, this metric works and this style works? Okay, it actually started off with this very important paper written by these two gentlemen, Farmer and French. Farmer himself is a Nobel Prize winner, and they came out with this paper titled The Cross-Section of Expected Stock Returns, and that was in 1992. And that's where they discovered value and the size factors, right? So how do you do it? So in those days, price to book ratio was one of the most popular metric that value investors were using, and value investors were generating very good returns. So these two professors wanted to see whether there is some truth to it, whether it can deliver higher returns. And they wanted to test this price to book ratio. Of course, they inverted it, but the idea is the same. Okay, so basically when the price to book ratio is low, the stock is cheap. Right, so with this one metric, they were able to determine what value means. And they calculate all the price to book ratio for the stocks in the universe. And they rank them from the most expensive to the cheapest. And they group them into 10 equal groups. Group 1 will be the most expensive group, and then group 10 will be the most expensive group. Will be the cheapest group, sorry. Alright, so that is the scale that we're talking about. And they tested and see the returns from all these 10 different portfolios. And what they found was that if you bought the most expensive group, the return was 0.64% per month. And then if you bought the cheapest group, you get 1.63% per month. And you can see this staircase pattern, right? And the cheaper you buy, the higher returns you get. And the difference between the most expensive group return and the cheapest group return was almost 3 times, right? So this is how they prove. Because if this price to book ratio doesn't work, That means whether is it group 1 or group 2 or group 3, they will return more or less the same return. It will be more like a flat line rather than a staircase pattern. So that is how they prove or disprove certain investment metric. So that was how value was discovered. And then they went on to discover size, and they found that if you arrange the stocks from the largest market cap to the smallest market cap, the smallest group delivers higher return than the largest cap group. Right? So this is the size factor that we talked about just now. So this is how factors are being done, right? Factors research. And the more important one, which is the profitability factor, which we will be using for this QMT strategy, is founded in 2013. And that was based on Robert Novimark's study, right? So he said that, okay, besides value delivering higher returns, there's another group of stock. They are not cheap, but they are very good stocks. They still can go up even more. And that was the profitability factor. The concept is the same. He used the gross profitability calculation, the metric, right, which is essentially gross profit divided by the total assets of the company. Okay, it looks a bit like ROA, but it's not. It's using gross profit instead of net earnings. Just by using this, and you rank the stocks from the highest gross profitability, lowest gross profitability, instead of 10 groups, he grouped them to 5 different groups. And he found that the highest gross profitability returned much higher than the lowest gross profitability group, which actually delivered a negative return. So this factor is also a good factor to use. And in fact, this is a factor that is easier for most investors or traders because this factor generates names that are more popular. As compared to value stocks, they usually are cheap, small cap, names that people are not familiar with. And that is one of the key reasons why I chose this factor instead of the value factor. All right? So what can we use with this? Okay, so what stocks to buy? We will do some filtering, right, using more quantitative method because factors itself is a very quantitative approach. And we want to find the top 20% stock by profitability factor. As I mentioned just now, is this formula, gross profit divided by total assets. Okay, so that is the formula that we are using. And we get this number for all the stocks. We will arrange them from the highest to the lowest. And then we will only take the top 20% to determine the universe of our high quality stock. This is the cream of the crop that we are looking at. Okay, the best stocks in the universe. They will give us a higher chance to beat the market as suggested by the study. So we are not reinventing the wheel. We are taking what has proven to work and apply it to the real market. Okay. And of course, the thing is that not all these high quality stocks are on the uptrend. Some of them can be downtrending, and that's where we want to use momentum later to filter out which are the stocks that are going up, which we can long, okay, rather than going and buy those downtrending stocks, which can go even lower in the short term. Example, right? So I show you the gross profitability of that 3 stocks over here, Meta, 3M, and ExxonMobil, right? So these are their gross profitability. And if we just quantitatively screen, right, let's assume we don't know their business well enough, we have not looked at their financial statements, we don't know what they do, and if we just use this number, we will know that, okay, so we will rank Meta first, right? So we should buy out of these 3, we should only buy 1, then we should buy Meta. Okay, so just using numbers to quantitatively decide what it is. We don't need to look at financial statements, we don't need to look at modeling, right? We need to do fair value calculation, right? All these are not necessary. Okay, because when we do quality momentum trading, it's more of a short-term kind of strategy. All this valuation is more for long-term, right? So these are not important, and we just use the gross profitability quickly to filter out what are the best stocks out there that we can buy. And the thing is that best stocks usually, or the best quality stocks usually have a higher chance of going up compared to the low quality stocks, right? So that's the idea behind it. And that was how I found this company called Veritiv, right? I don't know what it does, and the only thing that I know is because it has a high gross profitability. After I take the gross profit divided by total assets, right? I quantitatively screen out this stock, and I don't know what it does. Right? It's only on further digging that I know, oh, it's a packaging company. It's one of Fortune 500 companies, but that's all it is, right? I didn't even bother to look at the financial statements. I did look at some slides, and that's just to dig some data out to talk about it, right? Otherwise, I don't need. I just look at the gross profitability, right? So there was some story behind. They were making losses, and then suddenly in the COVID year, they make a profit, and then they project further a 3 times profit improvement. So there was a change in CEO as well, right? So there is a turnaround kind of effect that's going on for this company, but all in all, as I said, it was because of the high gross profitability that I discovered the stock. And imagine that we found the stock, right, through the screen, high gross profitability, but it's at 1 year high, right? And it is very difficult for many traders to buy at a high, right, the top right hand corner of a chart, because it always looks expensive. And the idea is always to, okay, let's wait for it to be cheaper and buy them closer, okay, to the average, right, or maybe to a certain indicators, right? But the concept of momentum is different, okay? Is to buy them when they have momentum, not when they don't have momentum. So we'll cover the momentum in detail in the next section, right? But generally, what I want to show you here is that high quality stocks have a higher tendency to go up even more. So let's look at this stock. It's at 22.88, assuming, right? And let's say you buy, and after that, there was indeed a correction, down 17%, okay? And of course, a complete trading strategy must take care of the sell criteria as well, right? Not just the buy part, okay? Which I will go through in the third section, right? Let's assume that you hold all the way, and then after that you're rewarded. It's up 86%. At this point in time, probably a lot of people will be thinking of selling their stock in order to capture the profits, right? You say, oh, it actually went up a lot, and it's time to take the profit, otherwise it may go back down, right? But sometimes this kind of uptrending stock, we have good news, we have strong fundamentals, it can continue to go up even more, okay? It can go up 163%, right? And it's not done yet. It can go up even more to 355% in the span of just 11 months, okay, before the sell signal trigger in. Right, so that is how a high quality stock look like. Fundamentally, we are able to identify them just using gross profitability, and that is a very quick way to just discard the rest that are not as high quality as the top 20%. We will apply momentum only on the top 20%. Okay, so that is the idea. What to buy? We will use a quantitative fundamental filter called gross profitability. Now let's move on to when to buy. Because a good stock, as I mentioned just now, may not be on the uptrend. It may even be on the downtrend, and that's not a way to buy them, right? You must buy them on the way up, not on the way down. That is what momentum is all about. And how do you look at momentum? It was actually discovered as a factor as well in 1993 by Jagadesh and Tiedemann. Okay, the title of the paper is over here, right? But let's go deep into the study results rather than reading the whole paper. Let me save you some time over there. And similarly, the concept is very similar to what I share with you for profitability, for value, for size, right? Because that's how the standard factor research has been done. But the difference between these and the rest is that this is more like a technical indicator rather than a fundamental indicator, because it doesn't look at any financial figures from the financial statements. It only look at historical price. And what their study shows is that historical price can predict future returns, right? So that is something that might be very surprising to you guys. Okay, nothing can predict the future, but using historical price, this the predictive value in there. Okay, what do I mean by that? So what they did was to look at the historical performance of all the stocks in the universe. Okay, the past 1 year. Right? They did for a different time frame, but most significantly, let's use past 1 year. And this is an easy to retrieve kind of figure, right? With internet today, it's very easy. Okay, what's the past 1 year return for all the stocks in the US, right? And then we can do a ranking even. So that's what they did, and they ranked from the lowest return to the highest return, and that's it. There wasn't any fundamental analysis. There wasn't any figures taken from the financial statements, and the returns, they just they just test forward, right? And they just see what is the group with the highest return, and then they discovered the stocks that have delivered the highest return in the past continue to deliver higher return in the future, and the group that deliver lower return in the past continue to deliver the lowest return in the future. So this is something that is very counterintuitive to a lot of traders, because they would think that what has gone up must come down and what has gone down must go up, right? But this is saying the opposite, that something that's gone up more continue to go up even more, something that gone up lower, gone down lower, continue to go down lower, right? So that is counterintuitive. So what's going on? That is the momentum factor we are talking about. And the other thing that you should note is that usually this forward performance is a short period. That means within a few months. Okay, within probably about 3 months, 6 months, 9 months, that kind of time frame. It is not in terms of years. So momentum, understand, is a short-term strategy. Okay, it's a short-term factor. It only lasts for a while. And a while, we can determine at this point in time, weeks to months. Of course, we want it to last as long as possible, but generally, they are more of a shorter term kind of trades. Right? So this is not to confuse with value, because value works as well. Something has gone down, really indeed will go up. But this will usually take years. So the rebound is a lot longer, and you have to wait a lot more. Whereas momentum is a short term. And short term, you go with the flow, don't go against the flow. Right? Because you can be buying and only to see that it continues to go down. Right? So that is how you can have a different perspective by using different factors to look at the stock market. Okay? And then the next thing is that, okay, so if we know that the past returns are important, the past return can help us predict the short-term movement in the future, we should pay attention to the trend or the returns of the stock. Okay? And it is subjective, right? If you look at the stock chart, if you're a technical guy, you always look at stock chart. And you look at the price movement, it's like, okay, so this is Apple stock chart, and AAPL, and this is Microsoft. Okay, which trend is stronger? Which trend is better? Right? It's very subjective. It's again using that kind of judgment call. Some people may say Apple, some people may say Microsoft. It depends on how you see the chart, and it is very subjective. Okay, so I found a better way, and there was a book by Andres Clernau. He's a fund manager. All right, so his book Stocks on the Move. I would recommend you to read it. Okay, it is one of the best momentum book, I would say, because it was very instructional. And in the book himself, he was sharing about quantifying the momentum. Okay, how do we quantify momentum? So he was using this regression concept. And you know, in school, in the past, I don't know whether you have lab works. We're given a graph paper, we're given some apparatus, and then we're supposed to take certain readings for apparatus, and then we plot on the graph paper, right? And then after that, we will draw the best fit line to find the relationship between two parameters. So that is essentially what regression line is all about, is finding the best fit line. Because as share price go up and down, you can draw a best fit line to see what's the slope or the gradient of this regression line. And of course, the steeper it is, the higher the momentum is. Okay, so now we have a basis. A gradient is a number, and with the number we can do a ranking. So for example, Apple in this case is 0.7. The number may be too small, so we're writing it down. And then for Microsoft is 0.9. So you can see that in this case there's no dispute, because one number is larger than the other. Microsoft has a stronger trend than Apple in this case, right? So it makes the judgment a lot easier, right? In fact, we are not even judging, we're just doing a very objective ranking and see which stock have a higher momentum, right? And of course, in the book itself, in Stocks on the Move, Andres Clernau didn't just use a linear regression, because linear regression is a line. He was using an exponential regression, which is a curve. Okay, because a curve is better at responding to changes in the trend, right? It's more quicker to do to get out of trend fast and to get in the new trend fast as well, right? So that is the regression line that we're talking about. Okay, so with that, we will be able to do a ranking. Okay, using the regression gradient, a curve of the curve, we will be able to rank them from the highest to the lowest, right? So now let's put these two things together. Okay, remember the very first step, the what to buy. We were using the profitability factor, and we want to rank them from the highest to the lowest, and we want to take the top 20%, and remaining 80%, we just discard them away, right? So just with this simple metric, we identify the best quality stocks in the universe, and that's what we care about, because higher quality stocks have a higher chance to go up in the share price compared to the bottom 80. Okay, then this 20% we will pass through the second filter, which is the momentum, because not all high quality stocks will go up all the time, right? Same thing, we rank them using the regression figure from the highest to the lowest, right? And then we take the top 20%. Okay, and the rest we just ignore first, because they do not have enough momentum, and this is the ones that are going up. So which means using this two-stage strategy, what we get is that we get the best stocks. Actually, I've written here the high quality stocks that are on the move, or the great stocks that are going up at this point in time. So that is where we want to put our money. Okay, the chances of making higher return in a shorter term is higher doing it this way rather than going against the trend. Okay, so let's put this into practice, right? So let's look at cloud management platform, in this case Nutanix versus VMware, and see whether we can pick the right one, right? So with gross profitability comparison, Nutanix is higher. Actually 34% is not bad, it will also pass through. Okay, but when it comes to the regression, and you will see that Nutanix is at a higher regression value than VMware, so the pick is going to be Nutanix rather than VMware. And when we take a look, right, it's indeed true for the period of the observation, right? So you can see Nutanix actually outperformed initially already, right? So Nutanix is more expensive. Usually people will still think in terms of that, and then they want to buy the laggard, which is VMware. It's cheaper. Okay, it's cheaper, right? But what happened is that the Nutanix went up while VMware actually went down for the period of comparison. Okay, so you can see that in the short term, it's better not to think in terms of cheap or expensive. It's better to think in terms of strong momentum or weak momentum. Okay, so that is a big paradigm shift if you're still thinking about valuation when you do short-term trading. Okay, next one, CRM platform, Salesforce versus HubSpot. Right, by the name itself, a lot of people know Salesforce, but HubSpot less so. Okay, more for the SME probably. Salesforce is more for the bigger corporation, and a lot of people will just by the name buy Salesforce, right? But if we look at the numbers, it's different again, right? If you look at both the gross profitability and the exponential regression, HubSpot is higher, right? And the right choice is actually HubSpot, okay, to do the momentum trades. And let's see what happens next. And you can see for the period of comparison, Salesforce was up 25%, which is very good, right? But HubSpot was up 130% over the same period in the same field, and that is 6 times more returns, right? So you can see the power of this factor investing, as well as combining gross profitability with the momentum factor, right? It can be a very good short-term trading strategy. Okay, last one, clear aligners between Align Tech as well as Smile Direct Club. Gross profitability, Smile is higher, but same thing, both will flow through because both will pass the top 20% by gross profitability. And then the exponential regression is also very close, right? But Align Tech has a higher exponential regression, so this is the one that you buy, right? If there is excess capital, then you might buy Smile Direct Club as well, okay? But Align is the first one you buy, compare with it between these two. And let's see what happened next. And we can see that Smile Direct Club went up 28%, Align Tech went up 81%, right? So the difference in momentum, even though it's minute, still continue to generate the performance difference, right? So I hope you are able to see this, how you can combine these two powerful factors together to form a very solid strategy. Okay, now let's tackle the last part, which is when to sell. Okay, if you have watched the video by now, you will realize that fundamental, okay, quality is a fundamental, or the profitability factor is similar. It's a fundamental analysis. It's good to tell what to buy, but fundamental analysis is very poor at timing. Okay, it's the technicals that are good at timing, and that's where momentum is all about technicals. It's about price, actions. So it will tell us when to buy and when to sell. Okay, so we have discussed what and when to buy. Now let's talk about when to sell. So let's assuming that we bought this stock at $116.80, right? Break all-time high, and we are not afraid to buy because momentum. We're momentum traders. And let's see what happened next. And then it's up 37%, you know, and it is difficult because when it comes to selling, we can be taking profit or cutting loss. Either way is full of dilemmas because in this case, we're up 37%. It's a lot in a short time, right? Some people find it challenging to even get 10% in a year. But getting 37% in just a few weeks, it looks like too good of a profit to give up, right? What if we go back down? There's this devil that's speaking in our head. Or should we continue to hold for bigger gains, right? Or maybe people will say that's greed, right? So there is this kind of dilemma that's always going on. Without any instruction to guide us or guidelines to guide us, it's very easy to make a poor decision when to sell or when to hold. Okay, let's say we hold and then it drop 16%, we'll hit ourselves, right? Maybe we'll finally sell it because we're afraid, right? Oh, now it's dropping. If I don't sell, maybe I don't even have 16%. Okay, maybe we sell it, right? Then only to see that, oh, we rebounded a lot to 78%. Okay, so you realize that selling is difficult because we always struggle and it always give into our emotions, right? What if we lose this profit? What if? There's a lot of what ifs, right? And stocks like this, they can go up a lot. Then when do you call the sell point, right? Should you take the profit? Maybe 292% is good enough, or maybe it can be a 5-bagger, right? For all we know, maybe there's really a lot of good news that's going on. It's so difficult. And then if you're too late and start dropping, okay, and until this stock is actually Zoom until today is about what, $100, right? Drop a lot already, and we might even make a loss from a profit position, turn into a loss position, right? So we need to know when to sell, and the trick is this, right? We're going to use a very simple but very effective technical indicator called moving average. And this is probably the very first technical indicator that you will learn when you study technical analysis. Okay, but don't belittle this moving average, right? Don't belittle that it is simple, okay, but it is very effective. So the rule is this: if the share price goes below the moving average, we sell. Right? As long as it keep above the moving average, we hold. Okay, so you can see trend up, and then the sell point is here because it cuts below. Okay, and if you don't sell here, the share price will have gone to about 100 plus, right? From a high of almost $600. That's how much loss from the peak to the trough looks like. All right, so be objective. Then you don't need to be in a dilemma. Should I sell? Should I hold? Just use this simple moving average to help you decide when to get out of a trade. All right, so you can see, okay, this is Alibaba. If you don't sell a stock, eventually it can go down a lot. Okay, so for example, you should have sold the Alibaba in November 2020 at a price of around 260. Right, today the price is below 100. Right, it's about $90 at the time of recording. Oh, that is a lot of capital lost in a stock. And it's not just that, it's also opportunity cost, because if your capital is stuck in this stock, you can't redeploy to another stock that may be moving up. Okay, so that simple rule can save you a lot of heartache. And Meta, this is something that also dropped a lot in recent days. Okay, and there was a 1 day 26% drop. You can see this big gap over there, right? But you could have got out of Meta much earlier in September 2021 at a price of $340, right? And based on the time of recording is 216. Okay, so we can see the big difference in that kind of loss, capital loss, right? You have take this capital and deploy it elsewhere after you sold it at 340. Okay, so you can see the moving average will save you a lot of heartache. Okay, this is Netflix again. The exit would have been at $600 instead of holding on to $300. Zoom, same thing. As I said just now, right? You have gone to 100. Okay, if you didn't exit in end 2020. Okay, so there are plenty of this situation where the moving average, although simple, would have saved you would have protected you a lot of capital. Right? C, another very popular e-commerce stock, and that dropped 64% in 5 months if you didn't exit from the moving average signal. Right? So don't play around with that moving average signal, especially when you're doing this momentum strategy. Okay? More examples, right? But you get a point. Alright, so you don't need very complicated TA. The selling part, just use the moving average to help you get out. Okay, of course, there are some other methods, like if there is a momentum ranking, if they are 4 out of top 20%, we can exit as well, right? But the key one is this moving average. Okay, and it also help you protect profit, right? So for example, this moving average, you can see over here, this blue line, it's a 100-day moving average. Sorry, I didn't tell you earlier the duration, but it doesn't matter whether you're using 50, 100, 150, or 88 or 200. I think the good range is between 50 to 100, right? Reasonable. The red line here is just something extra that I drew. This is a 200-day, okay? But I mainly use a 100-day to decide, which is also prescribed in the Stocks on the Move book itself. So you can see that this stock, oil and gas stock, has been doing well, right? The commodity stock has been running, and of course fall under the momentum strategy. And this can be used as a way to protect profits, right? Why would I say so? Okay, the reason is because as the share price go up higher, okay, the moving average also go up higher, right? And that means that I get to shift my sell higher and higher and higher, right? So the moving average don't just protect capital against losses, but it also protect profits, okay? And we don't decide because we don't know how high the share price will go to, right? Is it going to be 120, 150, 200? Nobody knows. But you do want to be taking out a position prematurely. So you let the stock run. Okay, let the winners run as fast as they can, run as far as they can. And if they decided one day to go below the moving average, then we sell. Right? So as long as the share price keep going up, the moving average will go up and we get to protect more profits. Okay, so that is the idea. It's not to take the profit at the top. Nobody knows where is the top. But it's to sacrifice a bit of profit so that you can continue to ride the trend as long as you can and as much profits as possible, right? So that's the moving average magic. It's not just for stop losses, it's not just to protect your capital, but also to maximize your profit and to protect your profit at the same time. Okay, Chevron, same thing. You can see as the price goes up, don't sell, right? Just continue and let the moving average do the talking. All right, the moving average will keep pushing up the share price. Okay, and then you just keep going and see how high it can go. ICL Group, you can see if you take any profits prematurely, you will miss out so much gain, over 150% over 15 months, right? And still going, you haven't really go below the moving average, right? So you really don't know how high a stock can go. Even an index can be done on using ETFs. Momentum can be done on ETFs as well, right? So this UAE ETF is up 67% because they are oil exporter and oil is doing well. And that's an index itself, right? 67% return in over 14 months, right? We are not talking about a single stock, it's an index. So that's a tremendous performance. And it's still in the trade. Just ride the trend as long as we can, okay? Corn, likewise, is an ETF. You can easily do a momentum on it, right? Not necessarily using futures, okay? Soybean, same. Right? So you get an idea. It's not to take profits prematurely, but to ride it with the trend as long as you can. And this kind of strategy is very powerful, right? In the book itself, Stocks on the Move, Andreas Klenow did it on the S&P 500. Okay, the momentum on S&P 500, not on the quality or the profitability factor I showed you just now, right? But the momentum strategy itself was able to beat the return with lower drawdown. Okay, the lower drawdown was also because there is a crash protection criteria. In the book, what it says is that if the share price is or the index, S&P 500 index is below its 200 day, because the index is taking a much longer moving average. If the index is below 200 day, moving average goes to cash, right? Stop buying stocks, right? You should be out of stocks already, okay? But if you have stock, just continue to hold until it go below the moving average. But you should stop adding stocks. And with that is the crash protection. You can reduce your drawdown during a bear market. Okay, so that is how he did it. I also do a separate back test. This is where I combine the gross profitability with the momentum, and what I got was similar results, higher returns and lower drawdown with the crash protection as well, right? So you can see that it is pretty powerful, this kind of strategy, and I think that it's simple enough and systematic enough for a lot of traders to do it. So I would say that this strategy have three benefits. One is that it's effective and it's based on empirical evidence, based on the factors research, so that we are using what works in the market, and it's not just based on gut feel, based on very subjective judgment, and we are quantitatively filtering out all the stocks in the market so that we don't miss any opportunities, we don't miss out any stones unturned, right? We make sure everything is being filtered properly. Very effective, as also shown in Andreas Klenow and a lot of those back tests. And it's simple, suitable for beginners, right? Because it's very rule-based, okay? We don't need to put in a lot of analytical work to it, or we don't need to look at financial statements, we don't need to do modeling, we don't need to look at stock charts. We can just quantitatively rank them and we will know exactly what to buy, right? So it's suitable for beginners, it's good for traders with little time as well. Okay, if you have no time every day, you're not a day trader, you you have a job, you have a career, you have a business to run. You can't just stare at the screen every day, every minute. And using this rule-based strategy, as long as the rules are triggered, then you take action. If the rules are not triggered, just leave it there and continue to hold. Lastly, it's systematic, so you know exactly when to buy and sell. You don't need to be left in a dilemma, having to think, should I hold, should I sell, should I buy, should I skip? So a lot of all this dilemma will cause you more emotional roller coaster feeling, as well as very suboptimal kind of decision making, right? So you want to minimize the emotions that's involved as well. So this is the quality momentum trading strategy that's about, and I hope that you see the merits of it. And in the future videos, we will be discussing how to apply to the market, and hopefully we will be able to see the strategy in its practical form, and you'll be able to find more trading ideas from there, right? So if you like this video, remember to give me a thumbs up and also subscribe to the channel so that you will get more trade ideas using this strategy in the future. We will be looking at real stocks, actual stocks at that point in time, and hopefully that will give you more trading ideas for you.